there definitely are some big dark clouds on the horizon, but we have global growth. We have low unemployment in the U.S. And the ability to generate forward momentum in the economy despite higher interest rates. So I'm smiling today.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. I often emphasize that the most useful people to interview are asset managers. Because they don't have the luxury of merely having an opinion on the road ahead, they have to commit capital to their convictions and be judged upon the results. Today, we've got the great fortune of being joined by one of the most respected capital allocators in the business, Jan vanEck. Jan is CEO of vanEck, an asset management firm with over $100 billion in assets under management invested across a wide family of ETFs and funds spanning equity, bond, commodities, digital, and regional asset classes. Jan and I will spend the next hour discussing his macro and market outlooks, as well as where he sees the biggest opportunities for investors right now. Jan, thanks so much for joining us today.
Oh, it's great being here, Adam. I look forward to talking again.
Thank you. I had a wonderful time talking with you at the conference that New Harbor put on. Really looking forward to following up with you here in this conversation. I want to start, though, by thanking you for making the time to have this conversation today. This is the day after President Biden announced that he wasn't going to be seeking re-election. I'm sure that threw a bunch of curveballs in a lot of people's batting zones on Wall Street, and I appreciate you still being able to take the time out of your busy day to talk with us about this. So thank you.
Sure, of course.
All right. Well, look, I got a lot of questions here for you, and I know that you prepared some slides for the audience, which is great. And I want to give you plenty of time to walk through those. Before we get to them, if we can just kick off the discussion with a question I like to ask everybody at the start, what's your current assessment of the global economy and financial markets?
Overall, I would say good to very good. There definitely are some big dark clouds on the horizon, but we have global growth. We have low unemployment in the U.S. And the ability to generate forward momentum in the economy despite higher interest rates. So I'm smiling today.
Okay, good. I'm smiling too because I've had a lot of experts on recently that kind of have a pessimistic outlook, and I've been getting people asking me, Adam, come on, bring some people on who've got a more optimistic outlook of where things are headed. So thank you for helping me answer that call. All right. Well, why don't we just start from there, which is researching your company. You don't really qualify vanEck as a value firm or a growth firm. You call it a macro firm. So on the macro side of things, what are some of the biggest trends you are paying attention to right now that you think offer the biggest opportunity for investors?
Yeah. Well, Adam, as you know, vanEck tends to take this big picture view of the world. So what's going on economically, politically, and on the technology side, and then how does that affect financial markets, rather than focusing too much on what's going on within the financial markets themselves. And the spirit of my outlooks, I tend to update them quarterly. I started this about 5 years ago. Is just to highlight what I think sometimes is missing in the conversations about the markets, and especially those things that really stand out from a historical, multi-year, multi-decade even approach. And I've got 4 different things that I've got on top of my mind today that we'll go through.
All right. Well, should we just roll up our sleeves and dig right in? Do we want to pull up your slides?
Yep. Let's try to do that. Okay. Well, here are the 4 items. So number 1, the stock market itself. Normally, I don't have a lot of comments about it, but it became extremely distorted at the end of Q2, with growth having this huge upsurge relative to the rest of the market. This is not a secret, but I think the way you can look at this in perspective, most people don't realize this has only happened really kind of once before in recorded history. So that's kind of an extreme that will lead to some insights, I think. Secondly, government spending. Third, just the state of the global economy that we talked about. Again, all of these have got some insights. And then last but not least, because the Ethereum ETF is going to launch tomorrow, I thought I'd talk about blockchain developments a little bit.
All right, great. I already have lots of questions, but I'm going to hold them until we walk through your charts here.
Great. Well, let's start with growth. So this is a multi-decade chart. The numbers are very small at the bottom, but it starts in 1991. And you can see that large cap growth performance against large cap value has only been this high during the internet bubble of 1999. So we know that we feel good because the S&P was up 15.5% in the first half of the year. We know that it's a mega cap growth stocks, but this isn't some blip like, kind of in the middle of a trend. More likely than not, this is an extreme that is certainly unlikely to be continued at this pace. So that to me means with your equity portfolio, and I know we've heard this before, but it really is time to diversify and make sure that you're not overweight to the mega caps. Because if you own an MSCI global index and an S&P market cap index, you're really overweight to those mega cap stocks.
Mm-hmm.
So let's just take, let me just show from a kind of multiple regime period. And what I mean by regimes is the stock market kind of has multi-year periods where different things work. And so you can see in this most recent time period, no surprises. NASDAQ is up 406%. S&P has done well. No surprise, equal weight S&P, which sort of de-emphasizes the mega caps. Small caps at 74%. International and emerging markets lag dramatically. So, and I'll pause at the end of the slide to see if you have questions, but what you can see here is that we had an inverse, basically, experience in the 2000s when China's economy was really booming. So during that time period, the NASDAQ fell for valuation reasons. The equal weight actually way outperformed the market cap weight. And then the Russell did okay, but international and emerging markets especially did super well. And then in case you felt like we hadn't lived through this before, of course we did in the run up to the internet bubble in 1999, 2000. So I love this longer lens, Adam. I don't know if you have any questions in particular on these different regimes.
Thanks. I always have questions, but I'll try to be brief here. All right. So what you're showing here is sort of, I'll get to the current extreme in a second, but you're basically saying, look, there's sort of a pattern of market cycles that we've seen where capital or returns shift from one series of sectors to another and then back again. And that's what we're kind of seeing here in the data. So I guess my main question is sounds like you're saying we're probably due for the next part of the cycle to dominate over the next bunch of years. Don't know how much yet. A, is that true? And B, in the here and now, what do you think the action is more likely to be? Is it going to be a rotation from the leaders to the laggers? Or is it going to be more the leaders just having to come down in price to try to bring that growth to value ratio in play? One is more of a market correction story. One is more of a market rotation story.
I think when the AI fever breaks, I think it'll be similar to the 2000s. Both the mega caps will come down and the rest of the market can go up. So I'm not sure, Adam. I don't have, this is all guesses about the future. So I want to be sure to say, just because I've got opinions and hunches, I really think there's multiple outcomes possible always in the future. But I think this is the question investors should be asking themselves, given how distorted the market is. Are we about to change regimes? Now, people have been saying this for probably a year or two. Adam, one thing that people focus on a lot is the change in 10-year interest rates. Is sort of saying we've been through 40 years of falling interest rates in the long end, and that's going to change the cycle. I'm not sure if there's a single thing or not, but yes, that is, I think, the most important question that equity investors have is, how do I allocate between these different types of stocks?
Okay. And let me ask you this, I guess two other questions, so I lied. One is when you say, understandably, diversify, I think you specifically said diversify out of the equity mega caps, which you could interpret as, okay, let me own some of these other equity sectors. Um, do you think that's more the right thing to do in this type of conditions we're seeing in the current environment? Or is it more diversify, like diversify into other asset classes? Draw down your percentage of overall equities, obviously bringing down your mega cap exposure, but put those in some other asset classes.
Yeah, I mean, I think it's really hard to get out of the market, meaning out of the stock market, unless you're in the face of a Federal Reserve that's about to tighten monetary policy really hard. So I don't think that's where we're at right now. I'm really talking about within your equity allocation. Really make sure that you're not overweight. And look, you could even just go to S&P equal weight, Adam, right? Or
Mhm.
large caps. You don't even have to go to mid cap, small cap, or emerging markets. I'm just saying the mega cap, the multi-trillion-dollar market cap companies. That's what I'm saying. Just make sure you don't have too much of your portfolio in them.
Got it. Got it. Yeah. And I am one of the things that's sort of different this time around in these past cycle periods that you've drawn out here is the concentration of ownership in those mega cap companies, actually largely because of ETFs, right?
Yeah.
And the programmatic buying that tends to happen when new capital comes into the market. So is there a greater risk this time around to the major indices from a rotation like the kind that you're expecting?
We're very stretched, right, in the context of history. And maybe I'll give you another chart that kind of talks about the same thing, which is if you just look at equal weight performance compared to the S&P market cap weight, the lower the line, the more equal weight has underperformed. So we're at levels, again, with the longer almost 25-year historical lens of equal weight doing poorly as during COVID 2020, and again, the internet bubble of 1999. So this isn't like a tech thing per se, but it absolutely kind of sends the same message, which is you're close probably to an inflection point because you
Mhm.
saw dramatic changes after kind of these levels were hit.
Yep, and just mean reversion would say, with a data set that this long, that odds are that this ratio is likely to go higher, not lower
Yeah.
over time. All right, so last question on this, which is just put on your mega cap bull hat for me for a moment. What do you think is the most compelling argument? Doesn't necessarily need to convince you, but what do you think is the most compelling argument that the mega cap camp is saying, no, it's different this time?
Yeah, well, let's go to the next slide. So this is NVIDIA, probably the strongest story, right, of the mega caps,
Mhm.
the kind of monopolist, if you will, of AI chips as we think of it today. And so what I would say is great business, um, vulnerable stock. And so let me explain what this chart is. This is simply the price earnings ratio of NVIDIA. And that it's on a looking forward basis because, of course, with growth companies, you're expecting earnings to be higher over the next 12 months than looking backwards. But even looking forwards, it's selling at kind of 30 times earnings, and that means you buy the stock, you need 30 years of profits over the next year to get your money back, and that's just super high. And that's super demanding for any stock. And so if there's any structural vulnerability to this story, it could be NVIDIA margins. It could be supply chain because of Taiwan. It could be competitors coming in with different chips. Any of those, I think, would cause this average valuation of 30 times forward to go back to where the stock was before it became a darling, which is about half down here. at the beginning of the chart in 2014, 2015. And Adam, that's 50% down.
Yep.
I think, and even if it did that, it would still be close to up on the ear or something crazy like that, right? So this is not an odd scenario, but you just want to make sure that you're not overly wedded to this particular story.
Got it. And I just want to note for folks that you have this somewhat unique advantage given vanEck and what it does as a firm. And maybe I should let you give the 30-second ability just to talk for 30 seconds about vanEck and sort of how it's structured. But you help create a lot of the most popular ETFs that investors use to invest in different sectors of the market. And I believe the most popular semiconductor ETF is a vanEck fund. Is that correct?
Yes. As they say, I am not talking my book. The vanEck Semiconductor ETF, which is ticker symbol SMH, owns a lot of NVIDIA. It's the biggest weighting is 20% of that index, and that's what NVIDIA keeps hitting every quarter, and we keep having to sell. But it's because it's been concentrated in the top 25 semiconductor companies. They've been the winners, and it's been the top performing, and also now the industry's largest. But yeah, we at vanEck basically love to have these macro discussions, but kind of let you decide whether we're persuasive or not in terms of how we think about the markets. So we don't really typically have one, solve it all macro fund, but we do have a bunch of different solutions. We're known for natural resources, but also we have a large cap U.S. blend strategy. That's one of our largest funds. So fixed income, we have a range of solutions. We hope you look at them.
Yeah, well, basically just to make sure it's clear to everybody, the way I think of what vanEck has really done is it has made it a lot more efficient for the individual investors of all stripes, but certainly the individual investor to come up with their own portfolio strategy and then execute it, where it's like, okay, you want to have exposure to this sector or this part of the natural resources space or whatever. Your ETFs make it really easy for the average person to do that.
That's the idea. Should we move to theme number 2?
Let's go to theme number 2.
Have you bought your equal weight S&P or the vanEck wide mode ETF yet?
I was literally, as I was giving my answer, yes, I was there pressing the buy button on it. Yep.
Excellent. Thank you. All right. Now this is, I would put it to answer your first question in the category of the dark cloud on the horizon. And it's just going to be a little bit about politics because it's unavoidable. And the one thing, again, here you're looking at multi-decade history, an extreme of the U.S. government budget deficit during full employment. So you've had this blue line, which is the deficit as a percent of GDP, go up during COVID, of course, during wars, during financial crises, but never when unemployment was this low. And the consequence of this is that there's a lot of stimulus coming on in the economy. And I think it explains a lot of what we've seen over the last year. Namely, we did not have a recession in 2023. Why? Because the government's spending a lot of money. Why is inflation, especially wage inflation, kind of higher, keeping overall inflation, kind of at the 3% mark as opposed to falling more? Because of the demand, I think, from the government. A lot of the job creation actually is from the government spending. And I think it also explains why the Fed hasn't been easing. So what I do on the next slide here is obviously updated after the weekend, is just list some facts. I'm not trying to, kind of be conclusory about this, but just, kind of money that has been spent under the Trump administration and under the Biden administration. So basically, we know that Trump is in favor of low corporate taxes, reduced immigration. The spending in particular is what I wanted to focus on. So the first, I call it major COVID spend, was $2.3 trillion. Then there was another supplemental bill of about $500 billion. And then at the end of the year, after he was not reelected, in order to get the budget approved during a budget standoff, he signed a $900 billion coronavirus relief plan. in December of 2020. So not that different from what Biden spent if you look at the top bullet on the right. So you had the Inflation Reduction Act of $800 billion, the CHIPS Act, which I guess is a little less stimulus, so that's $1 trillion right there, and then the $2 trillion 2021 spending plan when the Democrats controlled Congress. So Biden has been a little bit more explicit about what he would do to close that budget deficit. He's proposed a wealth tax on the wealthy and also an increased Medicare tax from at least from employees from 3.8 to 5% for those who earn over 400,000. So definitely big spending, but also some at least being a little gutsy, I would say, and talking about some of the tax increases. So we don't. And then lastly, at the bottom, I put down some tariff information. So I think the reason I put this stuff down, Adam, is just for us to ask, okay, in 2025, both of these parties recently have spent a lot of money, right? Now, both of them talk about government spending. It really, one takeaway, it really matters if they control Congress or not. Because if they don't control Congress, I think it could be hard to get spending approved or major tax reform. It would certainly have to be bipartisan.
Mm-hmm.
So, Adam, you're probably saying, I knew all that. The economy seems fine now. Why would they do anything? Why don't they just kick the can? And so you have to go to one of these charts, but short story is debt to GDP is going to explode shortly because of entitlement spending, Medicare, Medicaid, and Social Security. And so I don't know if the markets will allow Washington to not do anything. So that's really ultimately the question, and why I call it the 2025 fiscal reckoning. To me, if the markets become concerned about this deficit, and there's let's call it a failed Fed auction, whatever that might mean. In general, my base case is that the Fed comes in and somehow buys government bonds and solves the problem that way. So to make it less painful but if they don't do that, 10-year interest rates could go from 4.2% to 6.2% very quickly. And so that's why I'd rather stay shorter term in my fixed income right now, because even though this is maybe a small risk that the market reacts against this, it's an obvious, visible risk. Again, in the context of history, that's really it would be surprising to me if there wasn't any market reaction during this.
All right. So if I can just clarify to make sure I followed, you're saying that the people who can do math are saying, look, the debt's going to increasingly become a really big problem in these entitlement programs. And therefore, U.S. government has got to start showing that it's doing something about that soon. And by doing something, it sounds like you're saying get the deficit more under control, right? You showed the slide earlier, which I'm going to steal going forward, saying that we're at a historic extreme in terms of our deficit spending, given the fact that we're in peacetime and have quote unquote, good conditions, low unemployment, positive GDP growth, that type of stuff. And that if they don't show that they're making progress on the deficit, then the bond market is going to hold them accountable by demanding higher yields on the longer end of the curve.
Yeah, and the reason I pick 2025 is typically bigger policy moves, even painful ones, or maybe especially painful ones, happen the year after a presidential election.
Right.
So Trump's tax cuts, and it's also when a candidate has some kind of mandate from the people. So if I just flash back really quickly, Trump's tax cuts were enacted in 2017, the year after he was elected. And the big $2 trillion Biden spending plan was enacted in 2021, the year after he was elected. So that's just why I'm focused on 2025. Of course, the timing could be this month, or it could be in 10 years or 20 years. Just don't know.
Right, right. But to your point, I've actually talked about this with some other experts on recently, history shows this happens more often than not, as I think you've said. But look, you rip the Band-Aid off, you do the painful thing in year one because you have 3 more years after that to finish strong, right?
Yeah.
Yeah. Okay. But the other thing you said too is so we could decide, okay, we're going to rein down our spending and we're going to get the deficit under control that way. Or you said, if I got it right, we just follow the Japan playbook and the Fed just starts, basically writing big checks to monetize the debt. If it does, will the bond market be happy with that? Or will it revolt at some point in time too and say, hey, look, that's destroying your currency and we're going to want a higher yield?
I think the market's history is they don't react. The markets don't react. They're kind of happy if the government opens up its checkbook. You saw Japan be able to do this for 20 years.
Right.
It's a little bit of a more closed loop economy. So I think the constraints will actually be political. Frankly, if I were in my 20s and I saw us just having our budget, our debt explode like this, meaning that I've got to pay it over my lifetime and have less money for, kind of future generations, I think that's typically where the constraint has come, but really don't know.
Okay. All right. I don't either, and I've got lots of opinions, but they don't matter. The market's going to do what it's going to do.
Exactly. We can just watch them together.
Okay. All right.
So this last chart here, just to flash it up, is just to put today's interest rates in context. And I would just say, not amazingly high, number one. And unless we hit a recession, I'm not sure that a couple of ticks down on this line are really that important in the context of everything. But I don't know if you have any thoughts on this chart.
I do. I have a strong one on this one. So you said, okay, one not super high historically, which is true in an absolute sense, but obviously the debt that we have today way bigger than what we had back, say, in the 1990s, right? So the impact of 5% Fed funds rates today has a lot more weight than it did back then. But more importantly, you said, hey, this is fine unless we get in a recession. That's what this chart is missing, is the shaded recession eras. And if we can apply them mentally, they pretty much all come right after the Fed has hiked interest rates and then plateaued them, just like we are right now. And then what you see is, we start entering recession. Of course, we don't know at the time because it's declared in arrears, but pretty quickly the Fed begins to realize, oh, wait a minute, things are slowing a lot faster than I expected. And then it starts the panic rate cuts, which you see in every one of these other spikes here. So I know you're feeling somewhat good about the economy in the here and now, but what's going to make it different this time where history doesn't repeat itself?
Yeah, we're in a very, very odd situation because typically the Fed has cut rates to help either the consumer, right, or let's say a financial sector real estate market, or corporate America, right? And you can kind of blend those all together depending
or the
on
banking system. There's been a systemic threat, but yes.
Yeah, but now it's who's in good shape and who's not in good shape. It's the government that's not in good shape, to your point. Right. So we're yes, I should shade this for prior recessions, but really this is the first time where it's the government that's incurring most of the pain from higher rates, right? The consumer is all cashed up. They're happy to get higher interest rates from their banks and money market funds. Corporations are pretty deleveraged these days, so they're generally not in a big pain point. So it's the mystery. We don't know. I think it's just, my point is, we are in a place financially for the U.S. government that we have never been before, and that usually causes some consequences. Okay,
and I'm sorry to ask these 2 questions or make these 2 points, but I'll get skewered by the audience if I don't. And I'm not trying to be the bear raining on your parade, Jan, and I want to get to the things you're excited about, which I think your next slides start with. When you look at the consumers and corporations, one of the things I've been saying a lot recently is this is a time where it's really important to understand the difference between the mean and the median. And if you look at the average consumer household, they're doing okay, right? But that is skewed tremendously by the top 10% that's doing fantastic, right? And if you look at the median, they're actually hurting on a relative basis and getting further behind faster. And you can make, I think, an analog to corporate America too, right? You've got the Magnificent Seven or top 10 or whatever who are doing great and they're pulling up all the averages. But 40% of the other companies in the S&P 500 that aren't even profitable, right? So and if you look at so consumer spending, retail sales are kind of slowing down now, but there's only so many mansions and jet skis that top 10% can buy. So as the bottom 90%, if they continue to worsen, overall consumer spending will get impaired, and that'll impact the economy. With corporate America, they'd get affected by that, but also we have the corporate maturity wall that we're entering into, where billions of debt is coming up, corporate debt is coming up for re-rating over the next couple of years. I'm not trying to paint too dire a picture, but I don't think it's like smooth sailing on the consumer and the corporate side right now either, if you look at the median versus just the averages.
No, definitely. And arguably in Q2, especially, we started seeing signs of a slowdown, Adam. And you listed some of them. There's many. GDP growth is coming down, right? So
Yep.
Part of all that stimulus, I think, is starting to roll off, and I think the Fed is very watchful on that. So, I didn't say no clouds on the horizon. I guess
Okay.
I'm just trying to look at the darkest cloud, which I would say is the government. But
Is the government side, okay?
And really, if all of what you talked about doesn't result in higher unemployment, it doesn't. I hate to say this, I'm going to be really crude. It doesn't matter.
It doesn't matter, and I'm right there with you, my friend. I think it all depends upon what happens with employment.
And that's it's a little
weakening.
unbalanced towards
Yeah.
healthcare and government, and it's something we have to watch an eye on. And anyway, we could have a separate discussion about this, but I do think that enough employers see the potential of AI that their hiring plans may be more modest going forward, to seeing if they can retool to keep headcount the same and productivity higher.
Mm-hmm.
So I added the cloud to your list.
Okay, great. And I'm biting my tongue because there's a lot of things I'd love to talk about that too. But let's get to the other big trends that you're watching. And let's get some optimism, more optimism in here than I'm injecting right now.
Yeah. So, again, the first point was about about equities, let's call it. This is a little bit more about fixed income. This is just kind of what's happening in the world. And the positive story about global growth is kind of twofold. First of all, I'm going to talk about the longer term structural, and then I'm going to just talk about some shorter term stuff. But this will be very quick. So longer term, in the last decade, there were two countries that contributed to global growth. I'm oversimplifying, but basically it was the US and China. And the good news is that going forward, growth is going to be, just as China is slowing down, growth is going to be more diversified, which is really exciting. We've got one giant, which is India. And you can see here that if you combine India, Brazil, and Saudi Arabia, they're going to pass Europe, the European Union, in terms of percent of global GDP. So that's an accelerating trend, if you will, over the next 10 years. So that's great. That's generally good for financial markets, right? If global growth is positive. I am going to just not go through all the factors, but all of those countries are kind of restructuring.
Okay.
I just
sorry to interrupt, but I just want to make sure that's amazing, and that's a great stat about those three companies potentially becoming bigger than Europe. It does seem from your chart that the vast majority of the growth between now and then is India.
Yeah, 100%. Yeah.
Yeah.
But I guess what I would say about Saudi and Brazil, and I list them a little in these points, is that the complete restructuring of one of the biggest balance sheets in the world, which is Saudi Arabia, away from fossil fuels and towards many other industries, including sports and technology and finance, is having a regional multiplier effect
Okay.
because they're such. I mean, basically, MBS admires Elon Musk. So those kind of growth initiatives, the venture capital and kind of future restructuring means he's using the financial markets to accomplish some of this, not just government spending. And that's, again, having leverage points throughout the region, the UAE and, and other countries that are engaging with them economically. So I'll move on. I mean, I don't think this is particularly news or particularly timely. It's just a long multi-year trend. This is my there's two companies in India that are phone companies. They're effectively the survivors of a bloodbath war for market share. And so the costs fell so much that over 800 million Indian citizens now have access to the internet through this technology. And this is kind of a dated chart. And I don't normally talk about individual equities, but actually I didn't look at recent prices until early last week. And this stock is up 50% or 40 or 50% or so this year. So it's just a longer term trend. And I think that's why I like to do macro thinking, Adam, because these longer term trends, you can't fight them. Anyway, so that's the story about global growth. And my last slide on global growth is this one. PMI, Purchasing and Manufacturing Index, is just a kind of 0 to 100 index. When it's over 50, it's expansionary. And so we had a big change in there earlier this year where the global economy started growing. And, anyway, that's positive for commodities. That's exactly what you would have predicted. And this is exactly what happened. The commodities started rallying again in Q2 after a correction. And, my hunch is just that China is still going through very, very painful after effects of their property bubble. But I really kind of think they're more than halfway done with that process. And it won't be boom on the other side, but it'll be slightly more confidence, I think. We don't even need that, and we're getting global growth. So that would only be further upside.
Okay, great. So this kind of almost goes back to your first section, which is this is sort of what we would expect to see, perhaps, to power that return to the market cycle, part of the market cycle where emerging markets and other non-US markets really start outperforming. And what's nice about this, as you said, is we're seeing that we're now back to growth on this chart. We're seeing it be more widespread than it's been in the past decade or plus. It's not all just coming, say, from China. It's coming from some other powerhouses, which will look like they'll really be big powerhouses tomorrow. And they're geographically diversified too, which I don't know the importance of that, but I think, if like you said, in Saudi Arabia, they're not just doing state spending, but they're creating like a capitalist ecosystem there, that should be a force multiplier effect. So anyways, these are just, go ahead.
Yeah, sorry, and just to interject, sorry, but those stock markets won't do well without tech, right? I'm not suggesting there's some natural force of nature. A stock market, in order to do well, needs these tech stocks. I call them the internet stocks or whatever, that benefit from this economies of scale, large countries leveraging their technology. And you've got that in India, you've got that in China, you've got that in the United States. So you do need those stocks in your indices, right, to bring the overall market up. But otherwise, I really agree with what you were saying.
Okay, great. Look, I'm just hanging on by my fingernails here. So yeah, please, please clarify and elaborate. But I guess maybe sort of multiple trends come out of what you're putting your finger on here. One is that, yeah, if you've been in emerging markets, over the past couple of years, you've gotten pretty beat up, right? Maybe this shows that they'll now start providing a better return, and maybe there's some good values now to get in at, if you're looking with a long run perspective. But also, a lot of these countries are natural resource producers, or they're going to be consuming a lot of natural resources in their build outs. And so therefore, that will probably be supportive of commodities. I think I heard you say that correctly, right? So there may be multiple trends that come out of this from an investment standpoint.
Yeah, I just wanted to kind of make that point that in the, I'll call it emerging markets boom 1.0 of the 2000s, a lot of those countries had businesses that were growing and becoming more profitable. But some of those companies these days, like if you just take a typical company in like Thailand or Malaysia, if they don't have world competitive technology, then they probably don't have the scale where they can compete against a Chinese, Indian, or U.S. company. So that's my only point. I'm not in per se in love with the emerging markets asset class. I think you have to have that ingredient of companies with the scale and innovation that can drive future growth.
All right. So is it almost sort of like these mega cap stocks that we've had in tech recently, which is like, okay, hold some international assets, but hold them in the mega countries that are going to really that have all those ingredients for success, like the Indias and the Brazils.
Yeah, thank you. That's a way better way of saying it. That's exactly my point.
Okay, got it. Great. All right. So we've got this increasing tailwind out there in the macro world. What's next?
Okay. Well, it's vanEck, so we've got to talk about blockchain software a little bit. And before you even read the slide or anything, I feel like I want to stop sharing. I'm just going to make two points about Ethereum, which is a blockchain software that's out there. But just to take a step back, blockchain software has been around for about a decade or 15 years, I guess, better number. Last year, there was a big shift because the pricing of those databases became much lower cost and much more reliable. So that's not, I don't have that on a chart, I should, but that pricing decrease, if you will, has led to much higher growth. So again, without getting into the details, just look at the chart, and what you see here is daily transactions have been very, very on a high growth trajectory. And the two colors just denote the fact that Ethereum is a little bit more complicated. It's the Ethereum ecosystem, one of which is it has to ultimately run on that Ethereum database to be completely validated. But because it's more expensive, a lot is happening on side databases, I'll call them, or layer 2s or L2s. So you don't need to know any of what I just said. Just say, Jan said that the Ethereum ecosystem is growing at a high rate, and you can see that it's grown 7 times since 2019. So that's simply point number one. Ethereum ecosystem is growing. This is the second point, which is Ethereum has competitors and its market share has fallen. So I guess Azure Blue is Ethereum and the layer 2s. And what you can see here is that it competes against a lot of different databases. The dark blue is Bitcoin. So one of the biggest crunches on Ethereum, if you will, is when Bitcoin fees have gone up. But the second thing I would point out is the gray area here, which is Solana, which some people may have heard of. We just filed for an ETF on Solana. But Solana's market share has really been growing. And why? Because it's low cost. So, kind of my takeaway, this is just another slide that shows what a roller coaster the revenue is in the blockchain ecosystem. I won't say any more than that. But the main point on the blockchain stuff, Adam, is that Ethereum has cut prices, volume is going up, but volume has to continue to go up to kind of make the ecosystem net positive, for the people that have some ownership stake in the software. So I hope that makes sense.
Okay, so the audience watching here, just from my interactions with them through polls and comments and whatnot, not super duper crypto knowledgeable. We definitely have some big Bitcoiners and some crypto folks here, but I would say they're not the majority. So is your basic message here that, hey, we all heard about the blockchain now for a long time. A lot of average people probably still couldn't really describe to you what it is or what it does, but they've certainly heard of Bitcoin. They've probably heard of Ethereum. The takeaway I guess I hear from you is saying is, hey, even though those haven't exploded into common everyday usage where you're interacting with a blockchain and whatnot, it doesn't look like it's a flash in the pan. The development has continued to go on. The usage is still growing, and this is becoming a real component of the economy that will grow. So don't count it out. I'm not sure what the investment thesis is here, except to maybe buy some of the ETFs that give you exposure to some of these, because they'll become more, demand for them will continue to grow in the future.
Yeah, I think my main point, yes, I would put it, just some additional comments, sorry. Number one, I don't think Bitcoin per se has any competitors because it's unique, kind of limited supply. If you want to call it digital gold, it doesn't have competitors. Ethereum has competitors. It's just like a business. It's like a software company like Oracle in any other category. It's just, it doesn't have a headquarters. It has developers spread all over the place, but it has, like any business, competitors. And my point is, if you're going to allocate to Ethereum, you have to have some kind of view on whether it'll be one of the survivors in terms of will people use it. And so let me just fill in one blank. You say, Jan, okay, who are these 10 million people that is using this software? Like, why are they using it? And I think the first breakthrough use case is sending money around instantaneously and almost for free. Mm-hmm. And that's in the form of something called stable coins. Stablecoin just tracks the value of the dollar. So just think of it as another way of sending dollars around. And so when your bank is closed at night or on the weekends and you need to send money to someone, this is a way of sending that money. And that's the use case where it's, I'll call it quote unquote real, like volumes are approaching the Visa network.
All right. And are those done by corporate transactions where it's like I do it through my bank, but my bank is closed? Or are those more like cross-border remittances? Like I'm an immigrant, I'm living in America, I'm sending money back to my home country. Normally I have to do that through Western Union, and that takes a big fee and it takes time, where now I can just send that money instantaneously and there's almost no percent shaved off it.
Yeah, I think that's 100% right. You have people that don't have a strong currency, which is like 80 or 90% of the world, not just wanting to remit money at them, but also just wanting to keep it in dollars. So it's a safer way. Like if you're in Argentina and you've had your bank account confiscated twice in the last 25 years, you'd probably rather keep it in stable coins than in any other kind of format. So it's that individual use. And the other thing I have to mention is just that people use stable coins on these crypto exchanges. So some of the volume is just sort of financial because it's sort of the money market fund of the crypto exchange. So if you want to go from Bitcoin to US dollars, they use stable coins.
Okay. So because this is one of your four big trends, is one of the trends here, and I'm just asking this as a guy who is not an expert in this space, is the message here that just the blockchain is going to become used more and more in commerce in general? So as you described, Ethereum and its competitors, they're just software providers, like an Oracle or a Microsoft or whatnot. And it's just that more and more things that happen in the economy will begin to happen on the blockchain versus the existing leading software companies. And so this is an ecosystem to have long-term exposure to.
Yes, I think, listen, I don't feel, well, I do feel that people should have optionality to gold or gold shares or Bitcoin in their portfolios. Like that to me is a very useful tool. I think Ethereum is optional. I know we're offering a fund, but I kind of think you don't have to invest in blockchain software outside of Bitcoin. I obviously am, but my main point is like any investment, this is not a no-brainer. You have to follow what's happening with the fundamentals because Ethereum has competitors. And you may not know, if you don't know who their competitors are and you're not following it, you may want to let someone else do that allocation for you, I guess is my point.
Okay, great. And I would embrace that 1,000%. Yep. If you don't really understand the space, then don't be speculating in it.
Yeah.
Or at least speculating in it without a guide. Yeah. Okay. I think you have one or two more slides there, right? Yeah.
Yeah, just the wrap up. So I think since I'll just go straight to the investment implications. We talked about, first of all, growth versus value, how distorted the stock market is now. It compares to 1999, 2000. It doesn't mean that we're at an inflection point today, but that's what people should be looking at. At the end of 21, Adam, I was so bearish growth, I basically said go to cash because I just felt the whole thing was such a big bubble. I don't feel that way now. I think growth is extended, but I just would suggest a real reallocation and make sure your equities are not overweight the mega caps. So that's my point number one. Point number two, around the fiscal budget deficit, should be okay, but don't be surprised by a surprise. And that surprise would mean that interest rates at the long end would jump up. As we have seen with small caps, markets can move way faster than you can, reposition your portfolio. So that's why I like staying in shorter term fixed income. Good news on the global economy. We talked about that. And then lastly, blockchain usage is increasing, but just realize that Ethereum has more competitors than Bitcoin does.
All right, Jan, that was super helpful. Thank you for putting that all together. And like I said, talking to capital allocators, I always think they're the best folks to interview because they have accountability, at the end of the day. And you have so many different players out there, investors of all different stripes, retail, institutional, who are using your ETFs. You're kind of like right in the middle of everything. So you have I think a much more informed view than the average, expert I get to interview here. So thank you for putting so much time into this. I guess the only question I have, because you mentioned it right there at the end, you talked about the importance of having optionality or exposure to the optionality of certain key assets, given the current market environment. Can you just talk for a moment again about what those are and what is it about that optionality you find so important?
Well, I think, listen, we're in the age of technology. Everything is technology, and arguably everything boils down to the internet. So I just think there are trends. If that's the one trend, there are opportunities in India right now that are just in the category of very high conviction. I think it's very likely that the blockchain, which leverages the internet as well, is likely to put cost pressure on some existing financial systems. I just think it's a very high likely bet, and I want to have some money allocated to that. And so that's kind of really where. And then as you can tell, I do think there are certain, the market gets distorted, and I think there are times where you have to wave the flag and say, okay, well, don't be surprised.
Right.
Things don't go to the moon.
Okay. Well, one of the things I think I heard you mention was gold, and we talked about the New Harbor event where you and I first met, and they're active holders of several of your ETFs on the gold side, but the big one is GDX, the major mining ETF. And I think I heard you mention gold as one of those things to hold for its optionality. So specifically, why?
Well, the Fed is going to cut rates, right? I said maybe slowly or maybe, but that's where we are in the cycle. So that's when you want to own gold. Like it's that simple.
Okay.
You don't want it when the Fed's raising rates, but you really want it now. And especially, um, my the history of our company goes back to 1955, but my father started the first gold fund in 1968 because of this very same movie, which is government spending. And it seemed like that was never going to have consequences. And it took several years, but then the consequences were compounded by the OPEC oil price and all the other kinds of things. So I'm very bullish on gold and Bitcoin. I think it's a similar trade. There will be corrections, but both assets have hit all-time highs, and I think we're far from done with the cycle. So, yeah, I didn't bring it up. Thank you for flagging it, but and there's no particular news on that front. I would say it's just a good time. If you're going to be allocated, you want to be allocated now.
Okay. All right. And like you said, you sort of feel like this is history repeating a movie we've seen before, and one that actually was sort of seminal in the formation of VanEck. I guess last question on gold. You said you don't want to own it when rates are going up. You do want to own it when rates are going down. Were you surprised by how well gold hung in as the Fed hiked rates as aggressively as it did?
Absolutely. And normally the dollar weakens as well. So listen, part of the reason we know part of the answer why. So first of all, it's a mystery. You're right. Like, why is gold performing so well? Because we have outflows from US ETFs. We have a strong dollar. We have higher interest rates, right? That's just a mystery. Part of the answer we know is that foreign central banks want to use less government debt, tying into my second point, right? They don't trust our spending levels, and so they're buying gold.
Right. They're switching, they're selling the treasuries, they're buying gold. Yeah.
Yeah. I mean, there are a lot of people doing this. It's just that it hasn't really been reflected in the financial markets yet. So, yeah, I mean, absolutely. That's, that doesn't mean gold goes up further, but wow, it has performed really well, to your point.
All right. I'm going to have to end it there. So many other follow-up questions I'd love to ask, and hopefully that just means we can have you back on here again at some point in the future, Jan. And again, given kind of your catbird seat on all things financial, if you ever see trends emerge that you really want to kind of, amplify your message and letting the world know about, know that you've got an open invitation to come on this platform anytime you want in the future.
Oh, wow. Thank you.
So two last questions for you. One is probably the most important, which for folks that want to follow you and your work and your commentary going forward, where should they go?
Well, I'm on social media, so LinkedIn, Jan vanEck, JanVaneck. I'm easy to find. And then on Twitter, it's Jan vanEck number 3, so JanVaneck 3. I repost reluctantly, but content I really like, Adam. So maybe every 2 to 4 weeks is when you'll find me kind of endorsing other material or publishing something on my own. So, and then of course we have our own website with a lot more information, vanEck.com.
vanEck.com. Okay, great. So when I edit this, Jan, I'll put up the links on the screen to all those assets. Folks, I'll also have links in the description below this video too, so that if you want to get to any of those with just one click. And Jan, I'll call you out in a complimentary manner. There are way too many folks who are very smart, and I love what they produce, but they go for volume. You're one of the guys you can follow, and like you say, you don't get something very often, but when you do, it's going to be something that you think is really important for folks to know about. All right, so I've got one last question for you, Jan, and I'll give you 30 seconds to think about it. And it's just, given the fact that you've had such a successful career, you work in such a, I think, systemically important part of the financial action, and are just such a highly respected macro thinker. What's an important lesson you've learned along the journey that you think is worth sharing with this audience? Real quick before I get your answer, I'll let you think about it, like I said, for 30 seconds. Two things, folks. One is, if you've enjoyed this conversation, and would like to see Jan come back on the program at some point where he's got an update to share with us, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. I think when this comes out, we'll be just a couple of hundred of subscriptions to this channel away from hitting the 100,000 subscriber mark.
Wow.
And when we do, we get a fancy little plaque from YouTube, but more importantly, we burn more brightly on YouTube's algorithms. So please, if you can help us, folks, just hit that subscribe button. Totally free, only takes you a second. Secondly, Jan and his business are all about helping investors more efficiently invest for, whatever their investing outlook is, and making it easier to put together a portfolio allocation to support it. A lot of great trends that Jan mentioned here. If you want some help in trying to figure out how to actually make them personally actionable in your own portfolios, highly recommend that the vast majority of folks watching this video do so under the guidance of a good professional financial advisor who takes into account all of the macro issues that Jan has told us about here. When you put those requirements together, professional, good, and really educated on the macro side of things, sadly, the universe narrows pretty quickly. But if you've got one of the good ones, great, stick with them. They literally are worth their weight in gold. If you don't, or you'd like a second opinion from one who does, highly recommend that you consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses, like the folks from New Harbor, whose name I've mentioned a couple of times so far in this interview. To do that, just go to thoughtfulmoney.com, fill out the short form there, only takes you a couple of seconds, and you'll have a free consultation with one of these experts. They're totally free. There's no commitment to work with these guys. It's just a free public service they offer to try to help as many people as possible, position as prudently as possible for what might be coming down the road. Thanks for your patience, Jan. So yeah, back to that kind of big lesson that you've learned along your very accomplished journey. What would be your counsel for folks?
This is just what comes to mind now, but I would say, one thing in general, one thing about myself. So in general, the hardest thing for companies to do is to pivot, but it's like the most important decision. And companies would pivot their strategy for a lot of different reasons. I was just talking with our summer interns last week about Netflix. And so Netflix used to send out DVDs by mail, which was a big convenience. It was much more convenient for people than going down to a store and having to kind of rent a DVD and put it in your player, and they may not have it and all that kind of stuff. And then they basically completely said, we're going to scrap that and we're going to go to streaming, right? No more getting your DVDs by the mail, and we're going to move to this new format. And I just tried to, we talked about all the risks associated with that, right? What if people didn't want the streaming? How much would you charge? Like, would you charge per download, per week, per month? People in your household. And it's just, you don't have enough information when companies need to make those big strategic decisions, but you have to sometimes take risk and pivot. Mm-hmm. And I think when you look at the governance of companies, people talk a lot about founder-led companies are more willing to take that risk because they knew all the risks they had to take to get where they were in the first place. And so anyway, that's the one lens or filter now that I really look at when I look at corporate governance and looking at CEOs is are they able to pivot and all the constraints, right? All the vested interests that want them to keep doing things the way they wanted to keep doing them. We were lucky to pivot at VanEck into ETFs in 2006, and now that's 95% of our business. But you have to be willing to take some risks to do that. So anyway, that's that. I would say one thing I've learned about myself recently is, you can have different approaches towards problems. And I realized how heavily biased I am towards a glass half full kind of mentality. I look at that way when it comes to people, to business opportunities. I think I recognize weaknesses or problems, but I'm like, well, you can fix those, but it's always good to amplify the good. So I think that's led to a bias in my thinking, and maybe not always in good ways. But I ask people who are listening, how are you biased on that? Are you overly indexed towards glass half full, too much towards glass half empty, or are you balanced? I guess being balanced would be the best.
Okay, I agree with both of those. And the pivot comment I think is great because it's not just applicable to corporations, it's applicable to us in our own lives as well. And I'm sure probably almost everybody watching can think of a time in their life where they needed to make a big shift or should have made a big shift. And then, either they're a lot improved after that or they kind of regretted, man, I didn't take the risk when I should have. I'd love to talk with you more at some point about this topic, Jan, because I worked for 9 years at Yahoo, and I got a front row seat to a company that couldn't pivot, had all the opportunity in the world to pivot into some of the best opportunities ever to exist in business, and couldn't give up its clutch on the status quo. So totally, 1,000% back the value of what you just said there. And then, yeah, I took, understand your biases. And being real honest, I try to be very impartial. I think when it comes to the markets and the economy, I probably err naturally on the side of the glass being a little more empty. And therefore, it's really helpful to have people like you come on. I have Lance Roberts who comes on with me every week to really try to nudge my needle back more to the middle. So I think it's very helpful to understand your biases because there's once you do, you can lean into the better parts of them, and then you can find ways to complement yourself or defend yourself against, the parts of your bias that you're ignoring. Yeah. So anyways.
It's so funny. I describe it. Well, we all have, through behavioral economics, we know we all have biases. And so I said, don't worry about even remembering what they all are. But when you identify them, just put in a trick. And, it's funny how sometimes that trick is just talking to someone else, right? Because I forget, I don't even remember what it was, but like 2 years ago in the market, I was very bearish. And I was like, I know at some point it's going to be time to buy. I think it was after 21. And I would go to my friend, Charlie Cameron, who sits on the trading desk, and he'd go, not yet, not yet. I'd be just like itching to get back into the market. And that's, it's funny how a lot of times it's just that one person that can kind of make you be patient or whatever it is.
Yeah, and I talk about recruiting, a team to help you be a successful investor, and a big part of that is recruiting people who complement your biases, right? To try to keep you honest. One other thing too, which is by definition, when you get back to behavioral economics, we are blind to our blind spots. So a really important thing to understanding your biases is to invite, feedback from others, honest feedback about, hey, Jan, where do we think you're maybe not seeing reality closely, and then having the maturity to listen to feedback you might necessarily want to hear or agree with, because once you get a truer aspect of yourself, then you can actually make those smarter decisions about how to support yourself around it. So anyways, Jan, thank you again for just bucket loads of insights through this conversation. I really appreciate you coming on, especially, like I said, on such a busy day, and the door is always open here to come back on whenever you'd like.
Great. Thank you, Adam. It was really fun for me.
Same here. Everybody else, thanks so much for watching.